Yes, welcome to my channel once again. Today we'll be talking about an aspect of financial management, the introductory part that does not involve much calculation. And we'll be talking about financial management function and environment. Financial management function and environment. We're picking a subtopic under this, and this aspect of the syllabus entails carries a weight of 10%. It carries a weight of 10%. So today I will just talk about an aspect of the financial management function and environment. And in looking at these aspects, we'll be talking about the nature and purpose of financial management. The nature and purpose of financial management will be the subject matter of this class. But before I go ahead, I want to ask you, um, is this the first time you're coming across the word financial management? What can you tell me about financial management?
This is not
Financial
the first
management.
time I'll be coming across financial management. I feel financial management is just the way we manage our finances, our assets. So,
Okay, all right, it's fine. So I want to put that financial management is the strategic planning So financial management involve investment
You
decision.
were off, so you just came back on.
Okay, all right, no problem. So the nature of financial management. It's talking about the nature of financial management. Talking about the nature of financial management, that financial management involves planning, organizing, directing, and controlling the financial activities of an organization. So I said it focuses on the effective and efficient use of financial resources to achieve organizational goals. And this financial management, it entails you taking investment decision, financing decision, and also dividend decision. So in organization, there are quite a number of decisions you have to take. There are quite a number of decisions that an organization must take. So everything we'll be doing in financial management revolves around decision making. Decision making in terms of what? Wealth maximization. Decision making in terms of what? Stakeholders value creation. Decision making in terms of what? Profit maximization. And decision making in terms of what? Earning per share in terms of growth. So when we talk about investment decision, this is a process of determining where to allocate funds, where to put in money, that is where to invest. For example, it can be in form of capital budgeting for long-term assets. It can also be in terms of working capital for short-term needs. So investment decision, it entails both long-term investment in non-current assets and short-term investment in working capital. That is investment decision. You have the fund, you have the money. How do you utilize the money? How do you use the money? That is investment decision. Now, talking about financing decision. Financing decision. This involves identifying the best sources of finance. The best sources of finance. Now, for you to finance a business, let me ask the question now. What are the various sources of finance? This is a concept that is being discussed in commerce, secondary school, business studies, and the rest. So, what are the various sources of finance that you think an organization can have access to?
They can debt. They can borrow, finance by debt
Fine, yes,
or by equity.
fine. That is nice. Yes. So, financing decision, it entails identifying the best sources of finance. And this best source of finance can either be in form of equity, debt, or internal funding, such as plowback profit, retained earnings. Yes. So it can either be either in form of equity, debt, or internal funding. And this is very important form of decision because the management of the capital structure is important. These components put together, equity and debt, is termed as capital structure. If an organization is financed more by debt, it means the organization is geared. If the organization is just financed only by equity, it means the organization is what? Is ungeared. Is ungeared. So we'll be seeing more of this in form of calculation as we forge ahead in our discussion in financial management. Also, another form of discussion under the nature of financial management, or another form of decision under the nature of financial management, is dividend decision. dividend decision. When you make profit, are you to distribute all as dividend, or you have a percentage to distribute as dividend, or are you to keep everything and not pay dividend? So deciding how much profit should be distributed to shareholders versus retained profit for growth is another important form of decision that an organization have to make. So dividend, how should cash funds be allocated to shareholders, and how will the value of the business be affected by this? If we should distribute 80% as dividend and we don't have anything to retain, it is from what we retain as profit that we will use in enhancing the business growth. Or where you distribute everything you earn as dividend, possibility of the business growing might be in doubt, because all you earn as profit, you are eating it. You are not saving for expansion. So the decision on what to do is a very paramount factor under the nature of financial management. Now, the point is this: why financial management? Why financial management? That is the purpose of financial management. The purpose of financial management. The purpose of financial management. Now, the main purpose of financial management is to maximize the wealth of the owners of the company. In another way, it can be said to be that the purpose of financial management is to maximize shareholders' wealth and ensure financial sustainability. So all these include that what? The organization must ensure adequate supply of funds. This is the purpose of financial management, because when finance is not being managed, there will be a problem in terms of liquidity. So for we to have smooth running in an organization, there is need for financial management, and this financial management includes what? Ensuring adequate supply of funds, ensuring adequate supply of funds, maintaining a balanced capital structure is also a reason for financial management. Should we get more debt and less of equity? Should we get more equity and less debt? So this is important. This is important. And also, another purpose of financial management is ensuring efficient utilization of financial resources. So when there is a proper plan, when there is organization, when there is proper measure to control, it means an organization will strike an efficient way to utilize its financial resources. Now, another purpose of financial management is maximizing return on investment. Maximizing return on investment. The return on investment, how do we use it? This is also very key, also very important. And also, there is need for an organization to learn how to mitigate against risk. That is management of risk and maintaining liquidity and solvency. So when it comes to management of risks, we'll be talking about the issue of portfolio. Portfolio. How do we spread our risk? So all these are the purpose of financial management. So the point is this: financial management aims to support strategic business objective and long-term value creation. That is the purpose of financial management, to see that the core objective of the business is sustained and that the business continues till perpetuity. That is the ultimate goal of financial management. the ultimate goal of financial management. Now, on the screen, you can see a diagram, a chart showing an organization, a company, its source of finance, which can either be through debt or equity, and also a company showing how its funds can be utilized, decision making in terms of utilization of its fund. How much should we give as working capital? How much should we invest in non-current assets? What decision should we make regarding dividend? So there will be an inflow of money through debt or equity, and the utilization of the inflow will either be in form of working capital, investment in non-current assets, and payment of dividend. So when there's an inflow, it will be expended through working capital, through investment in non-current assets, and also through payment of dividend. So this is very important. This is just introduction to financial management. Now, the next thing under the financial management and its environment, under the nature and purpose of financial management, is the relationship between financial management, financial accounting, and management accounting. The relationship between the financial management, financial accounting, and management accounting. What is the relationship between these three items or these three concepts? Now, when we talk about financial management, financial management, now let's talk about financial management and financial accounting. Now, when you talk about financial accounting, what are we referring to? Any hints? Financial accounting. Financial accounting. Any hints? You are muted.
Financial accounting concerned with providing information about what happened in the past and plan for the future.
All right. That is nice. So financial accounting provides historical financial information, what happened in the past. And what are those things that happened in the past? What are those records you keep in relation to what has happened in the past? Income
Like
statement,
revenue record, income statement, costs,
yes,
and profit,
statement of financial position, and so on and so forth.
cash flow.
So financial accounting provides historical financial information. So we use this historical information. We use this historical information. The financial manager, the financial manager use the historical information provided by the financial accountant. So financial managers use this data to assess past performance and make informed decisions about the future investment, about financing, and dividend policy. So it is based on past record, the financial accounting record. Then the financial manager will now make a plan, organize, coordinate to decide what fraction of our investment should we put into working capital? What fraction of our income should we put into working capital? What fraction of our income should we invest? What fraction of our income should we pay as dividend? So financial managers use this data to assess past performance and make informed decisions about future investment, financing, and dividend policy. So while accounting Financial accounting focus on reporting. On reporting. Financial management focus on what? Decision making based on those reports provided by the financial accountants. So that is the relationship between financial management and financial accounting. So financial management, based on what we have on the screen, I said, should be distinguished from other important financial roles. That is, management accounting is concerned with providing information for the day-to-day functions of control and decision making, while financial accounting is concerned with providing information about the historical results of past plans and decision making. Now, let's see the relationship between financial management and management accounting. The relationship between financial management and management accounting. Management accounting provides a forward-looking internal financial data. That is management accounting now. It provides a forward-looking internal financial data. Now, when you talk about management accounting, you'll be looking at budgets, cost analysis, forecast. So this is tailored towards making a decision that relates to the management. You know, it's the management that will make use of the budget, that will look at the forecast, where we are now and where we ought to be. So financial management now uses this data to support strategic planning. That is, the financial manager use the data provided by the management accountant to support the strategic plan, to look at risk. That is, will there be any risk attached to the plan? Risk assessment and resource allocation is what the financial manager use the data, the information given by the management accountant to do. So while management accounting supports operational decisions, financial management translate that into broader financial strategies. Hope you are getting it.
Yes.
So in synopsis, I can just put a summary to say financial accounting entails recording and reporting past financial data. Management accounting provide internal financial insights, and financial management involves strategic planning and decision making. Now, the question is this: who are those that use financial accounting data? Who are those that use management accounting data? Who are those that use financial management information? Financial accounting information is used by external parties such as investors, regulators, creditors. In our elementary financial accounts, we have users of financial information. We have the internal users, we have the external users. So in terms of financial accounting, majorly, the external users entails investors, regulators, and creditors. Now, management accounting information is designed for internal consumption. Who are those that make use of it in the organization? We have managers, the executives. They are those that make use of the management accounting information. What of the financial management data? Who are those that make use of it? It's for internal consumption likewise. The managers and stakeholders. Now, who are stakeholders? In CSME, they talk about stakeholders. Even still in this course, we'll be talking about stakeholders. Stakeholders are those that have interest in an organization, those that have a stake in an organization. They are stakeholders. They are stakeholders. So now, when you look at the time frame that these informations are designed, now the financial accounting information is historical in nature. Management accounting information is future oriented, and financial management information is what? Is both past and
It's
future
what
oriented. And another thing you can look at in terms of these three information, these three data, is that financial accounting is governed by standard such as International Financial Reporting Standard. That is financial accounting.
yeah.
The management accounting is not governed by external standard, depending on the standard you've set for yourself as an organization. And also, the financial management uses information from both that is from both standard sets by regulatory authorities and by standard sets by the organization itself. So the result of financial accounting is termed as what? Financial statement. Yes. When you prepare your final report, overall, you call it financial statement, which entails various forms of accounts. So the result of management accounting is what? Is budget, variance analysis, cost report, and so on and so forth. The result of financial management is what? Is your plan to invest. That is your investment plans, your capital structure, your risk analysis. Ultimately, all these will result into you making a decision. In terms of financial accounts, the decision you can make is limited to direct decision. Yes, it's a decision that affects the users. In terms of management accounting, the decision supports tactical decision. In an organization, we have various levels of management. We have the
Yes.
strategic,
What
we
the
have,
tax
yes, the tactical, and the what?
and the operational.
All right. So those layers of management make use of the tactical level, make use of the management um, accounting information, and the financial management, the financial manager, in terms of decision, they are directly involved in financial decision, making. The financial manager, they make decisions that has to do with finance. How much should we spend? How much should we retain? How much should we pay out as dividend? That is the tax of a financial financial manager. So, in simple terms, financial accounting provides the historical foundation. Management accounting offers internal forward-looking insights, and financial management uses both financial accounting and management accounting to make strategic financial decisions. That is the relationship between financial management and financial accounting, as well as management accounting. So also, under this first part of the syllabus, we are required to identify and describe various financial objectives. Various financial objectives. Talking about financial objective, what do they want us to do at this point? There are various forms of financial objectives. We have stakeholders value creation, we have shareholder wealth maximization, profit maximization, and we have earning per share growth. So the point is this: the money you are making as an organization, what is your objective towards it? What is your objective towards it? In what way are you planning to make use of that fund as an organization? So that is why we are asked to look at the objective, financial objective, as it relates to organizations, as it relates to organizations. Yes. So the financial objective, we have stakeholder value creation. Stakeholder value creation. Stakeholder value creation. When we talk about value creation, what do we mean? This objective, this objective focus on creating long-term value. It focuses on creating long-term values for all stakeholders of the organization. Now, this stakeholder value creation, in an organization, you have shareholders. The stakeholder entails the community, the employees, customers, suppliers, the government, shareholders. So everybody that has interest in the organization, they are referred to as what? The stakeholder. Stakeholder. So talking about the financial objective, each of these stakeholder, there is what they look out for from an organization. There is an expected return. There is value addition they are expecting to impact their personality, to impact their environment. So this objective focus on creating long-term value for all stakeholders of the organizations and not just the shareholders. So stakeholders include employees, customers, suppliers, the government, the community, and the shareholders. So the point is this: instead of prioritizing just profit, this approach seeks a balance between financial returns and social responsibility. Now, the community that the organization domicile in its community, in its environment, should do something in return that will benefit the community. So the stakeholder value creation seek to strike a balance between financial returns and social responsibility. For example, an employee will look forward to the organization giving a fair wage, yes, a reasonable wage, a reasonable return, salary, yes, and also delivery quality products to customers. That is the expectation of the customer, that this product I will buy, I should get value for my money. Yes, as I invest in this product. And also, there is a need to ensure ethical business practices. You don't pollute the environment. You don't pollute the environment to disfavor the community. Yes, as we have in some parts of the country where mining activity take place, and the waste of the mining activity pollutes the water, affects the soil, and the community in return expect a compensation, and the waste should be channeled to the appropriate channel, not to harm the environment. And also, there is a need to maintain environmental sustainability. All these are what the various stakeholders will look out for. We look out for. That is stakeholders value creation. So this, the stakeholder value creation, it promotes long-term business sustainability. It improves reputation. Yes, it improves reputation and builds trust with all parties involved or affected. So the stakeholder value creation, it helps to improve reputation and build trust. Yes. So the stakeholder value creation said it promotes long-term business. It promotes long-term business sustainability. It improves reputation and build trust with all parties involved or affected by the business. So that is the stakeholder value creation. And also, we also have another financial objective which entails shareholder wealth maximization. Shareholder wealth maximization. The objective of this is to maximize the value of shareholders' investment in the company. Your investment in an organization, your expectation is that you get the best out of it in return. So, and how will you get the best out of it? Is when the price of the shares of the organization is well priced in the market. So the objective aims to maximize the value of shareholders' investment in the company. Typically, it can be reflected in the market price of its shares. So if an organization is doing well, reflect in its market share. It will reflect in the market share. So every organization, their primary objective, their primary financial goal is shareholder wealth maximization. So this is the primary goal in most organizations, to maximize the wealth of shareholders. And how does this come to play? This involves increasing share prices, paying consistent dividends, ensuring strong financial performance, and making strategic investment that increase the firm's value over time. So when this is in play, shareholders will have a sense of feeling there that the organization is faring well, the organization is healthy, and they'll be encouraged to put in their fund for more investment in the organization. So this concept, the issue of shareholder wealth maximization, it aligns managerial decision with shareholders' interest, and it emphasizes long-term growth, risk management, and efficient use of capital. So shareholder wealth maximization is a fundamental principle of financial management. You should seek to understand the different aspects in the syllabus. As we go ahead, we're going to see more of this in terms of finance, dividend policy, investment appraisal. So if strategy is developed in response to the need to achieve objectives, it is obviously important to be clear about what those objectives are. So most companies are owned by shareholders and originally set up to make money for those shareholders. So shareholders always want to get high returns, high dividend. So the primary objective of most companies is to maximize shareholders' wealth. And this could involve increasing the share price or dividend payouts. So this is shareholder wealth maximization. We'll tend to see more of this as we go ahead in the course of our discussion of financial management. So also profit maximization. What can you tell me about profit maximization?
Every company would like to maximize profit, like make the best profits that is obtainable, like trying to reduce costs to increase profit.
All right, this is nice. So profit maximization in relation to the objective. This refers to the goal of generating the highest possible profit. That is revenue less expenses in the short term. So in order to achieve this, firms may aim to reduce costs and increase sales to improve their profits. So most times, some organization often ignores risk, sustainability, and even long-term consequences just to achieve this objective to maximize profit. So profit is essential for survival. So solely focusing on profit can lead to poor decision making. Somebody must get to know that when you just look at making profit at all cost, it might affect or hamper so many things. Because when you try to make profit at all costs, you cut corners, there will be overpricing, there will be underpaying of staffs because you want to make profits. Your staffs are working, but you are paying them less and you are generating high profits. So these may affect the business. So every organization seeks to maximize profits. So in financial management, we assume that the objective of the business is to maximize shareholders' wealth. So this is not necessarily the same as maximizing profits. So firms often find that share price bear little relationship to reported profit figures. So there are a number of potential problems with adopting an objective of profit maximization. If your objective is solely on profit, the business might not stand the test of time. But if it is based on maximizing the shareholders' wealth, you want to keep doing things that investors will pick interest in the organization and they will want to invest more in the organization. So this is also an aspect of financing objective Another aspect is the earning per share. The earning per share. The earning per share. When you talk about earning per share, any idea? Earning per share. Any idea?
No.
Said?
No, you can't explain.
All right.
I cannot
So
precisely.
earning per share is the portion of a company's profit. That portion of a company's profit allocated to each outstanding share of common stock. That is the profit declared for the year in relation to the total number of shares owned by an organization. So earning per share is a portion of a company's profit allocated to each outstanding share of a common stock. So earning per share growth indicates an increase in the company's profitability over time. So it means the more profit an organization makes, the more, yes, the more earning per share, yes, that will accrue to a particular, to each shares.
Yeah,
So
okay.
earning per share growth indicates an increase in the company's profitability over time on a per share basis. On per share basis. So there are quite a number of formulas can use to determine that. So earning per share can be computed as net profits less preference dividend divided by number of ordinary shares. So a growing earning per share shows that the company is increasing its net income. Yes, a growing earning per share shows that the company is increasing its net income, because the more income you have, the more money you have to run the business. And not only that, a growing earning per share shows that a company is effectively managing its capital structure. The capital structure entails debt and equity. So it attracts investors and often leads to higher stock prices. That is earning per share. The importance of earning per share is that it's a key indicator of financial health. If an organization is faring well, doing well, you can know where it's earning per share. So earning per share is a key indicator of financial health. And it's also a key indicator of managerial performance. Yes, is the management performing well? It will reflect in the earning per share. And it's also a key indicator of investment attractiveness. If the organization is doing well to attract investors, hence it will increase its profitability. So many companies use earning per share growth as a benchmark for executive compensation and strategic planning. So this we've mentioned entails the financial objective. So a widely used measure of corporate success is earning per share, as I've earlier stated. Why? It's because it provides a measure of return to equity. So earning per share growth is therefore commonly pursued objective. Most organizations try to get their earning per share. A figure of their earning per share shows how they are faring, shows how they are performing. So the disadvantage of earning per share is that it does not represent income of the shareholder. Rather, it represents that investors' share of the income generated by the company according to the formula value creation, shareholder wealth maximization, profit maximization, and earning per share. So, in summary, when you talk about stakeholder value creation, it focuses on what? Balanced value for all stakeholders. Every stakeholder should fare well, should be very okay with the objective of the organization. And the key beneficiaries in terms of stakeholder value creation entails or include customers, the employees, societies, investors. And it look at a long-term effect. It look at a long-term effect. Now, talking about the shareholders' wealth maximization, it focuses on increase in shareholder investment value. How can we add value to the shareholders' investment? And the shareholders will be happy to keep investing in the organization. The key beneficiaries in terms of shareholders' wealth maximization are the shareholders. And it's also forward-looking. It's a long-term issue. And how do you measure shareholders' wealth maximization? You can do that through share price, dividend, return on investment. You can measure your shareholder wealth maximization. Now, talking about the profit maximization, this focus on an organization maximizing the net income, and the key beneficiaries of profit maximization entails owners, managers, and profit maximization is a short-term effect. If an organization is not making profits within a year, the owners, the managers will not be happy. So it's not an objective that is of a long-term nature. It's a short-term issue. So how do you measure profit maximization? You measure profit maximization through net profit. In terms of earning per share, earning per share growth, the focus of earning per share growth is on increased profitability per share. How much is a share bringing in? So the key beneficiaries entails the shareholders, financial analysts. They want to see the earning per share of an organization to be able to forecast, to be able to encourage investors to put in their fund. Now, the Earning per share growth is a medium to long-term plan metrics. Yes. In terms of timing, it look at the medium to long-term period. And how do you measure earning per share growth? You measure earning per share growth through earning per share ratio. You can also measure earning per share through the growth rate. Through the growth rate. So these are the major focus of the part one of financial management function and environment under the financial management syllabus. Other items we'll be considering subsequently entails the corporate objective and the influence of stakeholders objective. We'll look at this in our subsequent section. Thank you for following. If this is your first time of coming across my channel, you can do well to subscribe, like, and share.